Hey, Jeppe. We're muted right now.
Hello.
How you doing?
I'm good, thank you. How are you?
I'm good.
Very good.
Pretty good. See, your AUM is growing like a rocket.
Yeah. It's nice. It's been
Yeah,
an
really
amazing
nice.
few months and year.
Yeah, amazing. Great to see this. Hello, everyone. Thank you for joining. Jeppe, you may begin, please.
All right. Thank you, Thomas.
Thank
So
you.
welcome everybody, and the agenda. I'm Jeppe Kirk Bonde, and welcome. So the agenda for this afternoon or evening is that first I'll talk a bit about myself and my background, then my view of the market and investment strategy, and then I'll talk about the future and how my portfolio is currently set up in relation to that. And then finally, there'll be the opportunity for questions and answers. So the reason many of you are here is probably that I've had an average annual return of 34% since 2013. So that's better than most other investors you could fairly compare with. If you wanted a higher return to volatility ratio, you would have had to invest with someone like Ray Dalio, but then you would of course also have had a lot lower return. And if you wanted an even higher return than that, you'd have had to invest solely in Amazon or Tesla or something like that, which of course would have provided a much higher volatility. Now, I currently have 21,000 copiers on eToro and 250,000 followers, copying for a total of $45 million. And before I was an investor, I was a management consultant advising large tech companies and banks on valuation. So calculating how much is a company really worth, which is important if you want to buy or sell companies or make the right strategy for a large company. And then as I was doing that, I also started investing for myself. And then as that continued to go very well, more and more people started copying me. And then eventually I quit my consulting job to focus only on managing my investments on eToro. And then it just continued to go better and better since then. I don't do everything on my own. I have a good network of experts that I can rely on different topics. So usually when I invest in something, either I have to myself be an expert in it, or I need to know someone who is. And that's just a quicker way to get to the right insights. If I have any questions or concerns, usually eToro are quite quick to help me. I subscribe to a lot of inexpensive data tools that give me and digital tools that give me the analysis and data that I need to make the right decisions. Then I have 2 assistants that support me, and I'm also currently looking to recruit another full-time financial analyst. And finally, I think 2 of the most important people that support me are my brothers. One of them, he is an economist with the Ministry of Finance, and the other works with AI for a large tech company. So anything to do with machine learning or economics, I sort of brainstorm a bit with them. Now, my investment strategy is based on some principles that have been there all along and will continue to be there. What I invest in changes over time, but these fundamental principles of why I invest, they sort of stay the same. Now, I focus on macroeconomics, so reviewing all the different segments of the world markets and making an evaluation of what kind of growth rates I think the different segments can have. I look and scan for mega trends. So these are trends that can grow for more than 10% per year for at least a decade. Then I focus on fundamentals. So that means conducting due diligence on companies, really getting a 360 view of different companies. What are their products like? What's their competition like? What's their management like? What's it really like to work there? What different kind of future paths could they have? And so forth. All of that in order to estimate what kind of cash flows they could have in the future, and then how valuable that company really is today. And then I compare that with the effective price I'm paying today, and I want to invest in companies that are worth a lot more than they cost, that together fit well risk-wise. I focus on the long term. There's a great quote by Benjamin Graham, the sort of mentor of Warren Buffett, and he said that in the short term, the market is a voting machine, and in the long term, a weighing machine. And that essentially means that in the short term, it can be very important what other people think. But in the long term, if you've invested in a company at a reasonable price and that company becomes very big and profitable, then in one way or the other, you will make a lot of money off of that. And I'm happy to stick around and wait to see that happen. And now, of course, sometimes the long term comes a lot quicker than you anticipate. I had for many years believed a lot in work from home and work from anywhere. And then, with COVID, suddenly that just came true a lot quicker. But I would probably have been right on it eventually anyway. Then I focus a lot on risk management. So that means diversifying across geographies, industries, and business models. I currently have 51 different investments, with the largest one accounting for approximately 7% of the portfolio. And of those 3 points of diversification, the key one here is business models. There's a lot of large investors that think they're well diversified because they are diversified across geographies and industries, but actually all of their investments are about to be annihilated by Amazon. So on the business model, they're really not diversified at all, and that can be sort of a danger to their portfolio. And then finally, I hedge against tail risks. So tail risks are risks that are very unlikely to happen, but if they do happen, they would have a very big impact. So for those ones, I will generally at least have one stock that I think can do particularly well if that negative scenario was to materialize. Then I focus a lot on keeping fees low. So I avoid shorting leverage and high fee instruments. Stocks, of course, have 0% commission on eToro. If the commissions were completely different, maybe I would construct my portfolio slightly differently. And also I tend to keep my trade frequency, especially among the higher fee instruments, very low. Now, where do I then see some current opportunities based on these principles? I really like organic growth. So that means companies that are selling more or selling it at a higher price. But it doesn't mean companies that are just growing by buying others. So sometimes on the first page of the annual report, you can read, oh yes, again this year we grew revenue by 2%. And then I see, think to myself, yeah, you grew it by 2%, but that's only because you acquired some other companies. Actually, the core business shrunk by 4%. So it's really not that impressive. I like companies that are resilient, which means they can do well in multiple scenarios, including negative ones. So that can, for instance, mean having a future fit business model, being agile, or having a really good balance sheet. A good balance sheet that can mean different things in different times. What it means today is very different from a half year ago, I would say. So that's just an area where I feel I can find some extra value in certain companies that's overlooked by the market. I like companies that have high growth, especially if it's coupled together with high fixed costs. So high fixed costs means that as you grow the revenue, those stay more or less the same. And if you are able to grow your revenue a lot while keeping a large part of the cost base steady, or at least not have it increase too much, that can over years create a completely different picture of that company. I like companies that have a new strategy. But it's not enough to me that they say they have a new strategy. I need to see some real action behind it. So when the Danish energy company Ørsted, for instance, changed their strategy, they didn't just say they were changing the strategy. They changed the name of the company. They sold off a bit part of the company. So that really proved to me, okay, they're serious about this. This is really happening. And then, of course, that became an amazing time to come in as an investor. Sometimes you don't have to predict the future. It's enough to sort of just understand the present. So when Steve Ballmer, the former CEO of Microsoft, he held the first iPhone in his hand, he said, oh, business customers won't like this. It doesn't have a keyboard. It's way too expensive. I'm very comfortable with our position. And he was, of course, proven wrong by the success of the iPhone. And that was an example of holding the blockbuster product in your hand and just not being able to see that this is the blockbuster product. And many people have also recently made that same mistake with Tesla and many other companies that have amazing products. And I think if you can understand, if you're a good shopper, if you can just compare products and understand what are the key features, what's going to determine whether one product is successful or the other one. If you're a smart shopper like that, that's at least one part of the puzzle that you've put in place. And while that's not everything, if you get that bit wrong, then I think it's really uphill from there. And finally, I'd say I really like companies that are mission driven. So that's companies that and that's not just because I believe in the mission, it's because it often enables companies to attract and keep really good talent without overpaying them. So you have some companies where the smartest people in the world, they just really want to work there. They're willing to relocate and take a salary cut, whatever it takes to work there. And there are other companies where people are running away and they're bleeding good employees. And if you know what kind a company is, then that might not show up in the financial statements next quarter, but over 1 or 2 years, definitely you can already start to see that impact. Now, if we look, many people who copy me have this as their stock portfolio, and also they maybe have a property or a few properties that they rent out. And that makes good sense because historically stocks and property have been the best asset classes. bonds have been sort of okay, commodities not that great, and currencies quite terrible. So whenever I have anything placed in currencies, I try to get it shifted to the left in this chart and ideally over into some stocks. Now, if stock prices are currently higher compared to different profit metrics than they've historically been, so that puts the base case for the average profitability and return for stocks in the future slightly lower than it's been historically. That's okay. The stock markets are big. You don't need to hold everything. I currently think I've found better investment opportunities than ever before. So they are, amongst the so many different options you have, there is quite often some you can pick out that will be quite nice, even though I think that the average profitability of the stock market in the near term is not as great as it's been historically. Then when we look at the macroeconomy, I like to split it into the social and political and the technology and process based. So within the social and political, the most important factor in the global economy is trust, and trust has many avenues where it shows itself, but essentially one of the most important ones is all our social constructs. If we money, deeds to a property, stocks, bonds, etc., these are all just social constructs. If we believe they have value, then they have value. If we cease to believe in it, then that value dissipates. And these social constructs can help us facilitate transactions and agreements and cooperation, and that can create a lot of value. But again, it can also dissipate fast. Then there are some movement changes, movement and taste changes, where if they're coming from the periphery from a small basis, but they're growing at a high percentage rate, then within a few years or a small decade, they can suddenly go from the periphery to be very pervasive. If you got in on that early, that can be very attractive. Sometimes there are, I'll skip that. Within the technology and process part, there are great opportunities for investments all the way from the R&D lab and the breaking technology to the final stages of the retail shop where the customer meets the business. There are some companies that are ahead of their competition based on some best practices, but if these best practices are easy to imitate by competitors and others, then over time they'll slowly lose that advantage. However, other companies are really doing continuous improvement where they are not just ahead, but they're accelerating away from their competition. And if that's the case, then over a few years, then that can really cause a material difference. Then there are some mega trends that I've identified as extra interesting. So if a company is riding or driving one or more of these mega trends, then it's more likely to be found in my portfolio. So within digital transformation, I think there is a great distribution motor being created across the world, where the more people buy things online, the more times per day companies can come and do delivery. The more often they come, the cheaper it becomes. The more people will start buying online. And the companies at the center of this distribution engine, they have a very bright future with quite high profits. I think the future of security is very different from the past. So whereas the Second World War was won on logistics with tanks and aircraft and whatnot, then the future of security is more a battle of hearts and minds and a battle of ideas. So militaries may want to start hiring more journalists than soldiers. And in this sort of future of security, there are some companies that have the exact products that are going to be needed. And those, I think, will see massive expansion in revenue and profitability, and they are to be found in the portfolio. The companies that have made the biggest breakthroughs within AI and robotics in the past years are in the portfolio, and also some of the ones that I expect will make the next big breakthroughs. If we do one more vertical, work from home is the big story, but the real sort of long-term thing I think is the work from anywhere. That was going to happen anyway. It was made to happen more rapidly thanks to COVID, but this is a big important trend that is something you need to really think into everything. Clean energy has been a very big part of the portfolio, has been slightly reduced, but I think with Biden coming on and everything, there is a certain momentum and amount of capital being deployed into this, and that's only going to continue. If we then then when you've identified some industries or companies and you want to sort of get a quick overview of how they look in comparison to one another, a great quick way is to look at the multiples. So this is an example from FANG, so Facebook, Apple, Amazon, Netflix, and Google. You could also switch Netflix for Microsoft maybe, but This is just an example. So if we look in the top left corner, we can see that's the profit margin. And here we can see that they've all had quite great profit margins, but not Amazon. They're lagging quite behind in this one. If we look in the top right corner, we can see that they've all had great, amazing organic growth rates. But here Apple is lagging a bit behind, although Facebook's also quite a bit ahead. Now, the top two charts here, the higher the better, because they're about profitability and growth. But if we look at the bottom two charts, they're the lower the better, because they are fundamentally about price. So if we look in the bottom left corner, we can see that for Facebook, we are paying $29 for every dollar of profit we get. So that's sort of all right. But for Amazon and Netflix, we are paying $82 and $59 respectively. So that's quite high. We'd only want to pay that much if we believe they can sustain these high growth rates or maybe improve their profit margins. And in the bottom right corner, if we're looking at enterprise value compared to revenue. So for Facebook, we're paying $9 for every dollar of revenue. And that's sort of okay when we consider how much that revenue is growing and how much profit we're getting out of that revenue. For Amazon, we're paying a lot less, but we're also getting a lot less profit out of that revenue. But for Netflix, we are having a lower growth rate and we're not getting the same amount of profit, yet we are paying the highest price at $10 per dollar of revenue. So you'd only want to pay that if there's then some other factor that makes Netflix worth that. And so this is sort of a way you can quickly get a view of how different companies relate to one another. Now, unfortunately, I don't get to look at beautiful charts like this every day. What I look at most of the day is more like this. So very large data tables where I can sit and add things together and multiply things and then filter them and sort them and see which company is looking best in this one, which is looking best in this one, and so forth. A lot of these data tables are automatically updated from the various subscriptions that I have. Some of them I have to do manually or my assistants have to do it, where there's some way the number is coming in that I don't like. So there's some adjustments that must be made. I also have many uniquely crafted data tables. So this could be something like how beautiful are their websites, how much do I like their management on this metric, and then it's subjective, but it's also numerical, and all of that can be used to then make my analysis to value how much are these companies really worth and how do they relate to one another in terms of risk. My favorite unique data table I have is one where I've taken every single buzzword and concept from science fiction that exists. I think my list is 10 times longer than the second biggest list in the world, and then estimated when could we see all of these things happen and who would benefit and who would lose and so forth. And that hopefully means that in the future, when someone says no one could have predicted that, there'll be at least me who can say, well, I did put a small percentage that would happen. And those metrics that turn to nose analysis then in the end have to help me make investment decisions or inform me where I need to do more research. So with research, it could be that, okay, this company is different. I need to look at this differently. Now everything has to be updated so that it encompasses this sort of new thing. Or it could be that there is a company that looks interesting, but I just need to know more about this before I can, really evaluate it fairly. And in the end, all of that has to come back to investment decisions. And then when you add up all of those investment decisions, it of course becomes my portfolio. And if we look at in the USA, it's not just one industry that's accounting for all the economic activity. There's many different industries and there are many good investment opportunities across many different industries. My portfolio is slightly skewed towards tech, health, gaming, climate, finance. And if we look at particular stocks, then the largest one in the portfolio now is Afria, but I also have large positions in, for instance, Nintendo and Centene. And of course, you can always on eToro go in and see what I currently have in the portfolio. And yeah, so that was my presentation. If you have any questions, then now will be the time to ask them. If you remember your question at a later stage, then you can always go to my profile on eToro and comment there, or write to me on LinkedIn. And maybe you could also watch some of my YouTube videos where there are some answers. So Toma, if you could take from the chat and give me the first question, that would be great. And thank you everybody for listening.
Sure, feel free to open the chat, Jeppe, and read the questions, and everyone, you can unmute yourselves or write in the chat. There are already questions there.
All right. What's your short-term view of the SP 500? I generally don't take a short view, and I don't care about the short term due to it's like, you know, if you flip one coin, it's going to be 1 or 0. But if you flip it 1,000 times, it's going to be more or less, you know, 50% this way and 50% that way. So there's a lot of things where you think it makes a lot of sense to think like, how's this one event going to turn out? But once you add them all up, you care much more about where they average out to. So I don't really take a view. I can have like a base case estimate for the SP 500. Like in this one, I said 4%. So that's my base case. That also goes for the short term. But it doesn't really make sense to think of that in terms of 1 to 2 months. And in general, as an investor, if your mindset is on 1 to 2 months, yeah, you're just I think the best way to explain this, a lot of people think if you think about the short term again and again and again, then the long term will take care of itself, because obviously the long term is made up of all these short term periods. But the reality is that many of the amazing things you find, you don't know when they're going to happen. But if you see a great company, like I've done many, many times, where I'm like, this industry is going to be huge one day. This company that's a leader in it is only costing $2 or $3 billion. That's going to be amazing in the long run. But I can't say that they are going to be amazing next month, or everybody's going to realize what I realized next month. If I was right about everything today and everybody suddenly knew everything that I did tomorrow, yeah, then I would be right within one day. But that's not how it works. I say something and everybody disagrees, and then many, many years later they come around to like, wow, you certainly was right about that thing. And that's why it's pointless to say, even if I know that this company is super undervalued or super overvalued based on you know, a solid evaluation versus a not so solid valuation, it does not mean at all that that will materialize within a few months, because that depends on what other people think. What is your view on Bitcoin and crypto? So with crypto in general, I like the concept of crypto. I do not like the concept of blockchain. I think blockchain is a quite useless technology. It's not scalable. That's the core problem of it. And many clever mathematicians have tried to work out in the last years if this issue can be solved. And I think we can now confirm that it cannot be solved. And so blockchain is sort of a dead useless technology. However, many interesting things can be done with, for instance, Bitcoin, where you do transactions that are not really based on the blockchain. So you only settle on the blockchain as you would, for instance, have banks that settle with a central bank every 24 hours or something like that. So there's this idea that that a great cryptocurrency must also be a great transaction system. And I think those two are separate things. Like gold has remained a great store of value through history, despite the way we transact with gold changing over time. So, you know, used to maybe have to ferry the gold back and forth with a horse, and now you can just click a button and change ownership. So the currency has stayed the same, but the way we transact with it has changed. And that's what needs to happen with Bitcoin as well. And I think this, you know, what we've seen with PayPal and what we could potentially see with other companies is what's really making this seem more and more realistic. So with so I was asking with a couple of different companies within the healthcare segment, and within health, I don't have anything in pharma, but I do have in biotech and in affordable insurance. And it's not that I dislike pharma in general; it's just all the pharmaceutical companies that I looked at, they are not they have not seemed comparatively interesting. Seems like there's an increasing move of capital towards hedge funds. Do you expect different pattern to show up because of this? Maybe less passive investing friendly. So I think there's always this sort of like movement. You could say that people talk a lot about whether the market is efficient. There was once the efficient market hypothesis. And I think the reality is that the market is always medium efficient. So if you imagine a world where the market was completely inefficient, that means that anybody making a lemonade stand could sell it for billions, and you know, Facebook might accidentally cost $1. That would be completely inefficient. Now, a completely efficient market would of course have to encompass all information in the universe. So that's also completely impossible. So you'll always be somewhere in between that. And if you have a state where not many people are actively looking at valuing companies and bidding down the ones that are, you know, supposedly less attractive and bidding up the ones that are more attractive, then you will see the a lot of opportunities for people to come in and do that. And conversely, if Yeah, so if everybody's passively investing, essentially the prices would be completely random, and then there would be a great market for people to come in and actively invest. But if everybody's actively investing, then then you can rely on the prices, and then it's more attractive to be a passive investor. And then there is some balance where individuals will essentially see, is it worthwhile for me to come in and do a lot of heavy analysis work to try to find stocks that are undervalued? If too many people are doing it in your field, then it's not worthwhile. Then you might as well passively invest. And that's also sort of that also speaks into my far future, because as long as I evaluate markets and I think I see companies that are highly undervalued or other ways I can make money, then I'll continue to do that. But if 20 years from now I look at the markets and I don't think there's anything that I can evaluate as grossly undervalued, then I'll just be happy to, at that stage, say I'm going to get the market average and a little bit extra by being tax optimized and minimizing the fees. Then you can go into more passive investing. But those things will always tend to sort of like move a bit in relation to each other, based on whether or not there is enough to gain from being active. A rotation away from tech in 2021. So it's other people. I'm not going to guess what other people are going to do. There's a lot of tech companies that I think are really, really amazing. They're not that highly priced compared to the profits they already have and can probably continue to have. And then you get the kicker that, imagine one day one of these great companies announces a great new AI breakthrough and you're not a stockholder in that company. I would be more afraid to not be a stockholder in Google if they invent general AI than to, than for anything else to happen. So I think that and we had this Jeremy Grantham article recently that there's been talked a lot about, and I saw what's his name, the guy from Oak Tree Capital comment as well, and they're all looking at price earnings ratios, which is a quite useless metric. You can't compare growth companies and value companies based on how much value they have they're creating right now. That's that's like comparing a baby with an adult and then saying that the adult's clearly going to have a better life because he's already an adult. And so I think based on that, there are many amazing growth companies that, despite not even being profitable today, will have an amazing future and are well worth the money. And smart investors should invest in these and increase their positions in these if they haven't already reached a sensible amount. But I can't promise that people will actually do that. People will do all sorts of things. Which stocks would you hold a higher percentage in your portfolio? You're not concerned with your risk score. You have previously mentioned Palantir, but you've since cashed out. So that's the biggest one. Afria. So as I've mentioned, I try to keep my positions below 5% of the portfolio, and the only reasons I would have a position that's higher than that is either that it correlates negatively or very lowly with the rest of the portfolio. So that means that when the rest of the portfolio increases in price, this would tend to decrease, and vice versa, because in that case, a higher position will actually reduce my risk. But with Afria, I simply think that this is a grotesquely undervalued company. It's in my previous one of these ones, I mentioned Palantir. That one grew 200% since, and in my New Year's post, I mentioned Afria, and that one's grown quite significantly since. But I still think that this is absolutely ridiculously priced, and I would put all my money into this one company. But of course, that would never work risk-wise, and it has to make some sense. But if it wasn't for sensible risk management principles, then I would have a lot more in that. And if I were to suggest a much higher risk portfolio, then it would probably see a higher percentage in that. But risk and reward is what you have to always balance. And then I sort of target a medium risk, and I think that's essentially what's good for most investors, and is what I think is good for myself. And also, I have a lot of family and friends that cover me, and I think that's what's good for them. So even though different people want different things, this is sort of a good, I think, sensible middle approach. How long time do you believe in Tesla? So I used to have a lot invested in Tesla. Now I have a little bit, and that's because I never cared about electrical cars. I always found it a completely uninteresting market. When Tesla first came out, I didn't invest because it was, again, an electrical car company. It was when self-driving became a thing that I invested in Tesla, and I invested massively in Tesla. And every time Elon Musk did something stupid, I invested more, and that has turned out very, very great. But also recently, I've sold out most of my Tesla, not because I don't believe in the company, not because I don't believe in Elon Musk. I would almost sort of invest more in Tesla just from a charity perspective, saying that here, Elon Musk, take my money, because I know that you're one of the few that are focusing on the same priorities for Earth that I believe in. But there are some companies where I think the base case is not that great. I don't think Tesla is going to have the most amazing cash flow this decade, but I do believe that they are one of the at least 3 big players that could be the biggest company in the world in 30 years. And that's based on, for instance, having this fleet out driving, collecting data that really is enabling machines to view, to look and to analyze what they're seeing. And if you really then think about what that can be used for, it's quite amazing. And so in that, they have a completely unique position. And if you look at what you have to pay to have a company that has a chance at being the biggest company in the world 30 years from now, then in relation to that, Tesla is sort of okay priced, but not that great. And that's essentially why I reduced it a lot. I don't want to miss out on that small event that could potentially happen, but I don't expect that I'll be receiving huge cash flows from Tesla over the next decade. And someone says, Lars Tvede talks about a big crash around every 10 years and predict that we have around 8 to 9 booming years ahead of us now. What do you think about that? So firstly, there is the sort of rule that if something's been going on for 20 years, then on average, it's going to go on for another 20 years. Because if you don't know anything else, you'd assume you are on average in the middle of something. Now, people, when they look at cycles historically, they think, then you can just nicely continue this out in the future, but that's not really the case. You don't know if it's going to go up and then down, or down and then up. It's what you can more know is if you take that whole sort of history, it provides a certain amount of sort of scenarios that you could imagine repeating themselves or being twisted in different ways. And then, of course, in addition to all the ways in which you think the future can be different. And in respect to crashes, you always have to consider that things are only valued in terms of something else. So when you say, for instance, the stock market's going to decline, well, what are you really saying? You're probably saying that the stock market is going to decline when valued in US dollars. So it could also be that it's the US dollar that's gone up in relation to. And now if everything crashes, then sort of actually nothing crashes, because if everything's down by 10%, then when measured in terms of each other, it's the same. So if you really think everything's crashing, what's really crashing then is capital compared to labor. But you can even hedge against that. Then you just have to sign contracts for people to do labor for you in the future. Then you've protected that. So if there's a crash, it just means that one thing is now worth more in terms of something else. If you're diversified across the different aspects, then you're sort of safe. You might lose out when measured in terms of US dollars, but if you own companies, goods, commodities, and stuff, then you're somewhat protected, even though you might actually see that your portfolio went down when measured in dollars. And then I think a lot of people forget that there is also a risk of inflation. And if there is high inflation, then that tends to make properties and stocks rise in price. So if you have the central bank thinking that, okay, we're going to see some decline in economic activity going forward, and there is some damage that needs to be soaked up, they will look to split it between inflation, government debt, and the stock price. So you're not going, and you don't know exactly what that percentage split is going to be. So I don't think you can really, when my girlfriend, she read a report recently that said Goldman Sachs predicts that there'll be a big boom in April, and I sort of said, well, if that's what Goldman Sachs says, then then that's their view. But what you really have to understand is the central bank then reads that, and then if everybody could agree that that's what's going to happen, then they would already react to that and increase the interest rate, and then it wouldn't happen. So sort of it's an analysis that can make itself not come true. And so you don't have, it's not about like predicting what the market will do. You also have to predict what it'll be do minus what others will predict it's going to do. So yeah, I think you can always find someone that will say that the market's just about to crash, and if you keep saying that, you'll eventually be right. But then in the long term, when you look back, you probably lost a lot of returns trying to dodge that little crash, and you could actually have much more afforded that crash if you had been invested all along. How would you mitigate a crash? So it depends on the details at the time. So in March, when COVID happened, everything sort of dropped with the same percentages. So that for me was a good time to say, okay, clearly everything's not equally impacted. All valuations aren't adjusted by the same amount. So I quickly identified which of companies that I track are winners, losers, and neutrals from COVID. And then I made sure that I didn't have any losers and had a lot more winners than neutrals. And then that turned out very well. And in another crash, it depends on what it does to different valuations. If exactly 20% of Earth is destroyed and all stocks go down by 20%, then from an investment perspective, it really, nothing's really happened, because, okay, yeah, now it's worth 20% less and it costs 20% less. What can cause some action is that there is a discrepancy where it's, wow, this has fallen a lot, but actually its value is only fallen by this amount. Or there could be something that I hold that where it's like, wow, the value has completely deteriorated, but the price has only fallen by a bit, so I want to get rid of this now. So it depends on that at the time. Now, of course, I have lots of different scenarios for exactly what could go wrong, and there's lots of companies that I track but haven't invested in yet that are based on specific scenarios happening. So where I keep following these companies because I think if certain things were to happen, then these could become very interesting. And then when that happens, I want to be up to date on them, ensure that they are, getting all the right level of care in my financial models and my evaluations, so that yeah, when their day comes, then I'm ready. What do you think about Norwegian Air? So what do I think about Norwegian Air? I think I prefer EasyJet, but it's not really. I don't think it's ever been, and I don't think it is a very very attractive industry. I like what yeah. How will you manage a market crash moving forward after your 18 Q4 and 2020 Q1 losses? So again, I certainly don't expect that I will be having positive returns every month or every quarter. Historically, it's been 70% of months, but that's not a goal at all. The goal is the total average long-term performance. It's not it's not about avoiding the bumps along the way. I'm very happy to see the portfolio decline in certain periods, because it doesn't really matter to me. It's like, obviously you would have wanted to sell at the right time and buy at the right time all along the way, but this is not really the highest profit business in the world of investments. There you can sort of look at, you can always get the market average plus your skills plus your luck, and the one you can adjust is the skill bit, and there you want to be sure that you are getting what's called alpha, like the excess return. You can only do that by adding extra insights to the market. And I'm not the fastest trader. Quite often when there's new information, I'll be the very last person to react to this, not the first at all. And if there's a drop, it doesn't mean that I suddenly quickly have to act. No, I'll very nicely and calmly review what's happened. And once I feel I have a complete understanding of it, then I'll make an adjustment based on what's going to happen in the far future. And then various things happen along the way. But then in the long run, it didn't matter if it happened in year 1 or year 2. After a decade, the sort of ability to be long-term right will supersede it. What do you think about the FIRE movement, and what do you think about the 4% withdrawal rate per year? So I think the FIRE, so that's financially independent retire early movement. I think that's a great movement, although I do think that and the mention of the 4% safe withdrawal rate, I think it's safer to use 3%. So that essentially means if you have $1 million invested, maybe mainly in stocks and bonds, then you can expect an annual payout from that of $40,000 or $30,000. So if you I think many people, they don't realize how easily you can become financially independent if you essentially just take a few years where you earn but you don't spend, and you invest that. Then with the market average of 7% per year, you would essentially be doubling the value every decade. If you double the value every decade, it goes from 1 to 2 to 4 to 8 to 16 to 32 times the money. Now 32 times the money, then you are already getting like more than that 4%. So yeah, within a lifetime, you can essentially, just from working 2 years and saving that money, by the time you die, you'll have saved up enough that 2 of your children will never have to work in their lives again. And that calculation is totally missing from everybody's head. Of course, everybody thinks that their subjects should be taught in schools. I don't get why schools don't teach kids about taxes and personal finance and how much you can actually make from investments in the long run. But that's unfortunately how it is. And yeah, many people are sort of finding out about this through the FIRE movement. I think on the retirement bit, many in that movement are retiring too early with too little funds. You should be able to survive through a crisis and also be able to live a bit I think to have a little bit of extra money in your everyday life. So I'd be careful with retiring too early to be financially independent. I like your investment fundamentals and your approach to investing. I'd like you to stick around for a few more years, Nitoro. How long do you expect to continue doing this for before kicking back on a beach? So as long as if I look at the markets, make my analysis, and find investment opportunities that I think are extra attractive, and then it's worth my time, then I will keep working on this actively, being an active investor. Now, maybe that'll be for 10 or 20 years. That's my base case. Could also, of course, be as long as Warren Buffett. He, has been a leading investor into a quite high age. So it's, of course, possible, but certainly not guaranteed. But one day I expect that I will analyze the markets and I won't see any great investment opportunities. At that point, I will convert the portfolio to a boring passive investment portfolio where the goal is to optimize on taxes and keeping the fees to a minimum. And then I'll be happy to get the market average plus the little benefit from having used lower fees and tax optimized way. And then it'll go on from there. So I don't know if that's going to happen. In my base case is that I can continue being ahead and accelerating away from others for 20 years. But there's no guarantee. But I certainly I think then at that point maybe also many of my investors will be happy with a passive fund and at that time. Do you see a correction in the stock market this year? So the big corrections tend to come from one of two things. Either there has been some companies lying or governments lying about the reality of their finances, or there is a change in interest rate. And both things can happen at any given point. I like to think of the world economy as being full of little bubbles that can pop. They can either, and there are some of them that are very good. It's a little technological innovation that a company has made, and they're going to reveal it. And once it's revealed, everybody's happy. Then there's some other little bad things, and you don't know which one's going to be revealed first. And so so that sort of makes the short term unpredictable like that. But it's also not the important question at all. It's one that I get asked a lot, but it's really important to think in decades rather than months or even years, because that is, it doesn't have to be like that always, but that has historically been, and I very much believe that is the way to make the highest returns right now. So Trump based on Biden. So as that as the campaign unfolded, I kept adjusting which states I thought were gonna swing which way, and my portfolio was of course designed that it would be fine whether Trump or Biden won. I think, for instance, Centene Corp that I've invested in, they are one that would stand a better chance under Biden and under Trump. So for them it's nice. The green tech stocks I think have a better chance under Trump, but then there are other stocks that could possibly have performed better under Trump. But I think people put a lot of sort of they think that it matters a lot who is president in the US, but the reality is that it's a big tanker and you can only steer it a little bit as president. And there's lots of things that are happening. Like we are going to be dealing with climate change, and there's lots of other things that we are going to be doing. It's just a question of sort of like, do we advance this agenda a bit first or that agenda a bit first? And again, it's not like massively, it's just like, we're changing this by 1% or that by 1%. And there's a lot of things that will have a lot of symbolic importance, and they'll have a lot of visibility in the media. But once you divide up the numbers, they don't actually matter. So you have something that gets all of the media attention, and you're like, wow, 1,000 people are doing this, or wow, they're going to sign this agreement. But once you divide the 1,000 people up with the 300 and something million people, you're like, wow, this actually makes no material difference in terms of numbers. And you have something else which is like, wow, they're really going to change. No, the CO2 emissions were going to go like this, and now they're going to go like this. That's what the numbers will tell you. So even though something will take up a lot of media space, it doesn't actually, once you look at the numbers, have to match reality at all. Should I copy you with more than 5% of my portfolio? So my portfolio is already a diversified portfolio across the different aspects that I've said. So you can have that as your entire portfolio. You can also, as many people do, copy multiple popular investors, or take a segment and say, I'm going to copy Jeppe with this bit. I'm going to invest in just the average stock market ETF with this, and invest a little bit with myself on this one. If you have to if you have to, I would say just copy me with everything for many people, but for each person it's different. And you can, if you really want to make the most optimized portfolio for yourself, you actually also have to take into account, what assets do you have outside your stock portfolio, what kind of liabilities do you have in your life, where do you, what are the different risk levels you're trying to like what's your risk appetite, what's the risk level you're trying to achieve, and many other things. So you can make it a very, very, very detailed analysis to get to the very right answer, but it's not a portfolio where I'm only like doing one little thing that definitely needs to be mixed in with lots of other things. It is a fully contained portfolio that has that is fully diversified, thus the reasonable risk score. So it's not that you can't have that as your main portfolio. Someone asks, they have a 14-year-old son that invested their Christmas money on eToro. He thinks copy trading is boring, but I have a fan. Well, that wasn't a question. How do you see renewable energy in the future? So I think renewable energy is the future. We're going to have a lot more capital coming into renewable energy, but you also have to appreciate that the prices have reached a quite high level. So a lot of the companies that have a great future is also built into the price now. So you're not getting these completely free deals that I was getting, a few years ago, where you were paying essentially the same for a black energy company and a green energy company, even though they were clearly gonna go in different directions. Now, I like green companies better, but you're also paying a lot more for them. So it's not a free lunch anymore, I would say. How much of one's portfolio should one keep in cash? So again, this comes down to the detailed personal risk management, which is a difficult exercise. In general, I think it's good to have enough cash to meet your expected and likely unexpected expenses, but that's outside your portfolio. So if you get a bill for the dentist, or your car breaks down, or whatever it is, you don't want to have this become a cash management exercise. Personally, every year I review my cash position and I analyze how much cash I will have every month, so that I can find out exactly how much I can plow into more investments. And that's of course the sort of, if you're really going to overanalyze and doing in the optimal way, that's the way to do it. You want to always know how much cash you're going to have at different times, to know that you can put in the maximum into assets that provide a higher average return in the long run. Because essentially cash, as shown, is a quite poor asset. It has that inflation going against it, and not just inflation, it has the full seigniorage. So often if the economy is growing and the money supply is growing, that can sort of, then the prices will not change. If the amount of money is growing faster than the economy, then you'll see that turn into inflation. But actually you're losing that whole bit. So you're sort of losing the inflation plus the growth of the economy. That's the total seigniorage. And so that sort of, many people will just stay in cash or low yield bonds for their whole life. And they're happier to lose 2% every year or 4% every year than they are to gain 20%, lose 10%, gain 15%, lose 7%. They're not comfortable with that sort of thing. But if you are comfortable with that, then that can be the difference between two people making the same income, and then when they're retiring, one has built a family fortune and the other hasn't, even from just a normal income. What would happen to our investment in you if you were to become incapacitated? So eToro already has a full plan in place for this. So if a popular investor for one reason or another cannot continue, then the copy is closed, but you keep all of your positions, and then it's up to you to decide what to do with them. So you will still have your Apple stocks, you own your Apple stocks, but now nothing's automatically going to happen to them. So you can decide if you want to keep these Apple stocks or sell them and invest in something else, or maybe sell everything and copy someone else. So my view on emerging markets. So I think there are many countries that I like more than others, and there are within those countries, specific companies that I like more than others. I generally like to look at specific companies and not the big asset classes. So many people that are sort of like global macro guys, they sort of, I think, they sort of lose touch with reality, because they're thinking too much in terms of like, how is stocks doing compared to bonds, or how are emerging markets doing compared to developed economies.
That's right. It was a great call, Jeppe. And thank you for the great presentation. If you want to say a few words here before we end it.
I'll just say thank you everybody who came along, and thank you very much for the questions. And of course, if you didn't have your question now, then just ask me on eToro or LinkedIn or something. And yeah, enjoy your time with eToro.